Good morning and welcome back to Almus Market Mornings. At the forefront of today's updates is the potential Russia and Ukraine peace deal. More recently, we are seeing momentum build up on the peace talks, and it seems to be more optimistic this time around. Moving on to markets, US consumer confidence saw a steep decline in November, and that may be another point in favor of those within the Fed looking to cut rates. Dollar weekend, euro had a good showing, and gold held its gains. Today, of course, UK budget will also be closely watched. Good morning, JK. What kind of new trends are you seeing emerge? I mean, we are seeing dollar unable to hold on to its gains currently as the peace talks develop. Do you think we can see some more euro positive developments?
Good morning, Swaraj. So, this sudden positive development on the Ukraine peace process is definitely welcome. However, there was some positive reaction from euro, which is like kind of a relief rally. You can say minor relief rally, nothing major, and the moves are all well within the ranges seen recently. Important point is that there seems to be still big differences on some of the key points. And Ukraine and European leaders are reportedly trimming down the plan to about 19 points from the 28 points that Trump had, drafted. And they even Putin, while reacting positively, is also saying that we need to see or discuss further because Ukraine has also proposed some changes. So overall, the market reactions, I would say, has been guarded. If you look at the gold, it is still holding at the high seen yesterday, closer to that. And the gold being one of the premium attached to it because of geopolitical concerns, has not given up its gains. Oil also has not broken into new lows. It has held broadly above $61 for the Brent, and so I think still some progress needs to be seen. Uh, Cannot rest until the final sign off is done. Yeah, if it does happen, we will see the euro probably gain some more. But I think unless 1.1650 breaks, the confidence for a new bull run in the euro is not going to come back. In fact, market has been looking at the recent data from Germany, where the IFO business confidence came lower, and the GDP final revision for Q3 also showed that economy continues to be in stagnation, and this is the longest period of economic stagnation that Germany has seen since World War. So at the same time, ECB is also keeping likely to keep its rates unchanged because inflation has, according to them, bottomed out. So we have to wait and see what German government does for uh, bringing the economy out of the stagnation, and whether the big spending that has been talked about for quite some time now actually sees the light of the day. So I think to assume a bigger euro rally, we need much more than the peace progress, on the Ukraine side. We had quite a few indicators from US also yesterday. Consumer confidence, as you mentioned, also came, which came much lower than expected at 88.7. And October it was at 95.5. A lot of references to the ongoing labor market problem, the tariffs, higher prices, and even the government shutdown. These have actually impacted the sentiment. Of course, the lifting of the government shutdown this month would probably see the index improve a bit, but then concerns about prices and also tariffs do remain, and also as well as the employment situation. So I think this consumer confidence is still now hovering at the lows, and these are the levels where we have seen even recession in the year 2020 as well. We also had quite a number of data from the government side about the retail sales and PPI numbers, but these were pertaining to September. So the observation with this, with a limited implication, is that inflation is not spiraling wildly, at least from August to September, at a wholesale level. Consumer spending strength seems to be weakening. That remains a concern, and definitely is going to be lower for the month of October. November would be a question mark because you might see higher spending due to Thanksgiving occasion as well. So I think market will look at the numbers, upcoming numbers in December, before we can draw a definite conclusion about the economy. Meantime, we had another weekly number from ADP. That's weekly NER pulse that shows that employers trimmed an average of 13,500 jobs per week during the last 4 weeks, ending on November 8. And that shows continued deterioration in late October, and now shows that 8 of the 13 releases have actually printed negative so far. So we have a situation where uh, the data is sparse. At the same time, there is a wide division among the Fed members on what happens next on the rates. It seems to be fully divided now, and Powell will have to actually, make a choice where which team he goes with. He may either cut rate as the markets now expect, and use the exquisitely negotiated post-meeting statement to signal a higher bar for further reductions, or alternately he may hold the rates steady and wanting to reassess in Germany when the official numbers will be out for the month of October and November as well. And both these approaches will have their positive and negative arguments in their favor. Meantime, markets have now priced in 84.7% likelihood that rate cut will happen in December. That's quite a jump from almost 30% probability that we had seen in the last couple of weeks. So on the dollar overall, I am not seeing much of a trendy move. We have had the dollar weaken against the euro slightly, and also on the yen, mostly based on the yields falling. Yields now hover near 4% for for the 10-year tenor as well. So the yen also somewhat cautious with continued verbal statement from Bank of Japan officials. However, I would still see it as a correction from the big rally that we had seen from 154 to 157.90. So sooner or later, as the risk sentiment improves further, we might see more yen weakness, and until we actually see an intervention, it is unlikely to see any strength. Also, the sterling once again surprisingly holding up well along with the overall dollar weakness, but definitely market is looking ahead to tonight's budget and its implications. As far as the rupee is concerned, RBI has once again contained the rupee weakness well ahead of 89.50 that was seen on Friday. Yesterday, initial offers were seen. They later on, just as it was approaching the 89 psychological mark, we saw a lot of demand emerge once again, and that's quite reasonable because there is no, positive factor that is helping the rupee to go below 89 right now, having broken the long held resistance at 88.80 on Friday. So I think any approach to 89 or slightly even below will lead to a huge amount of buying from the overall market. Just for a perspective, if assuming we do have a peace plan in place, or the peace process does conclude positively. Ukraine war started in on 24th February 2022. At that time, dollar index was at 96, went up to 114, but now it has given almost all of its gains. Oil was at 96, went to 140. It trades well below that level. Russian ruble also, whose assets about 400 billion was confiscated by US, has almost recovered all of its losses. But INR, which was trading at 74.65 on the day the war started, now after 45 months, when the war seems to be ending, we are at 89.20, nearly 20% weaker. So clearly, there are a lot more which is driving the INR lower, and it has its own challenges. Most of it is, I think, capital flows, which has been missing for quite some time. This is all despite India recording the largest growth among the major economies, and inflation falling to its lows. I think there's something much bigger positive than the war ending is required for INR to see some sustainable recovery. Otherwise, current policy of gradual depreciation of INR is set to continue. Thank you.
Thank you, Jake. And that's quite a great perspective if we look at the when the Ukraine war started and where asset prices were and where they are now. And we have seen rupee being a stark sort of underperformer, being driven by its own sort of factors. Otherwise, markets continue to price in more probability of a rate cut in December. We also had one more indication of a lower consumer confidence. We had some older data from the US economy, which was the retail sales and PPI numbers. And so even though it's old, one thing is that it's not indicating any sort of spiraling of inflation as of now. So that's also an important factor that may add on to market's expectation of a rate cut in December. Otherwise, the positive development on Ukraine peace talks, that's there. There is some relief rally. The key points, I think President Trump had initially planned for a 28-point peace plan, and that has been trimmed down to 19 points as of now. With a lot of these points need to be directly negotiated between Russia and Ukraine. We'll see how all of this plays out. So these themes are what's going on in the markets, folks. We'll keep you updated. That's it from us today. Thanks for listening. We'll catch up tomorrow with the fresh round of updates.